Hey, welcome back to the What the Wealthy Do podcast summer series where we're revisiting some of my favorite episodes and some of yours too. I am your host, Stephanie Dorsey, the CEO and co-founder of Margins Capital. Margins Capital is an investment firm that not only provides private wealth management education, we also provide access to women and people of color to an institutional quality portfolio of alternative investments. We're going to construct an actual retirement portfolio strategy and show you how you should be thinking about it depending on what age you fall into. So this is the blueprint. Shout out to my favorite rapper, Hove. This is how you build a retirement that is not just funded, but is optimized for taxes, diversification, and long-term wealth. And so before we get into it, you already know what it is. This podcast is intended to provide financial education and not financial advice. So especially with your retirement, definitely work with a financial advisor or CPA to make sure that you're leveraging these strategies in a way that is aligned with your personal situation. So your retirement question is not how much do I have in my 401k? Instead, it should be, do I have multiple income streams across multiple tax structures and asset classes? And here's the framework the wealthy use and the one that we're building for you today. There are 3 pillars of an optimized wealthy retirement portfolio. The first one, tax diversification. You need to spread your money across different tax-deferred, tax-free, and taxable accounts. The second pillar is asset diversification. Your money needs to be spread across stocks, bonds, real estate, and alternative assets. And then the third pillar is income stream diversification. You need multiple sources of cash flow in retirement. If you build these 3 pillars correctly, you'll have control over your taxes in retirement. You will be protected against market crashes. You will have predictable income that you can't outlive because we are living longer. And you'll have legacy wealth to pass down to your heirs and progeny. So let's build it step by step. Let's talk about the first pillar, which is tax diversification. Remember how last week we talked about RMDs or WMDs or tax bonds? RMDs are your required minimum distribution. But this is how you diffuse it. Spread your retirement investments across 4 types of accounts, each with different tax treatments. The first bucket are tax-deferred accounts. Those are your traditional 401ks, your traditional IRAs, your SEP or self-employment IRAs. And how it works is you contribute pre-tax dollars, so you're reducing your taxable income today, and then your money grows tax-deferred. And so you pay ordinary income tax when you start to withdraw or take distributions in retirement. Don't forget, we talked about required minimum distributions, RMDs, WMDs. They start at the age of 73. And so you definitely want to use these accounts, especially if you're in a really high tax bracket now and you expect to be in a lower tax bracket when you retire. And you certainly want to use, from a 401k perspective, you want to use this account to get your employer match, because that is literally free money, and you will pay tax. I'll gladly pay taxes on free money, but it's free money. So we definitely want to use that. The wealthy approach is you don't want to overfund this bucket, but you definitely don't want to poo-poo. We don't poo-poo free money. You want to contribute at minimum to get your employer's match and get some tax savings, but you don't want to put everything in this bucket. Okay, that's bucket 1. Bucket 2 are your tax-free accounts, like your Roth IRAs or your Roth 401ks. And so you contribute after-tax dollars, no tax deduction today, to these accounts. And your money grows, but your money grows tax-free. So you pay taxes today so that you don't have to pay taxes tomorrow. And withdrawals in retirement, like I said, are 100% tax-free. There are no required minimum distributions, no RMDs. And you definitely want to use it if you're in a lower tax bracket now and expect to be in a higher tax bracket in retirement. And this is also a wonderful way to leave tax-free wealth to your heirs or whoever you're leaving money to. The wealthy love the Roth IRA because tax-free income gives them control in retirement. They can withdraw without triggering higher Medicare premiums or Social Security taxes. That's very, very important. Pro tip: the backdoor Roth IRA. So if you make too much money to contribute directly to a Roth IRA, income limits for 2026 are $165,000 a year if you're single, $246,000 if you're married. You could do a backdoor Roth. That is, you contribute to a traditional IRA because there are no income limits, and then you immediately convert it to a Roth IRA. You pay the taxes on the conversion. The wealthy do this every single year, to build tax-free wealth. Don't forget about Peter Thiel, right? For those of you who funded your self-directed IRA with old 401ks and invested in a margins fund or some other alternative investment, you could convert your self-directed IRA to a Roth self-directed IRA by paying the taxes now before they grow tremendously. Peter Thiel did this with his PayPal stock, and now he has $5 billion, billion with a B, sitting in a Roth IRA that he will not have to pay taxes on. So we gotta move like they move sometimes. It ain't all bad. Some of it's bad. We know that. But it ain't all bad. Okay, the third bucket is your brokerage account. It's your regular schmegler brokerage account. And so you contribute after tax dollars, like you paid your taxes, you got your salary, and you're putting money in your brokerage account. You pay taxes on your dividends and your capital gains as you go. So long-term capital gains that are held over a year are taxed at lower rates than ordinary income, like 0%, 15%, 20%, depending on your income. And obviously there are no required minimum distributions. There are no contribution limits, and you get to borrow against it like the wealthy do and avoid taxes altogether if you don't sell any of your investments that are held in your brokerage account. So when do you use your brokerage account, or when do you invest in your brokerage account? After you have invested to at least get the match in your 401k, after you have leveraged your Roth IRA, now we're going to start putting money in our regular brokerage account. And I'm going to keep it a buck. I said that like it was sequential. It's not necessarily sequential. You could be doing all this at the same time, right? You do what makes sense for you, to be clear. And so the wealthy approach, this is kind of how they think about it. They use their brokerage accounts to invest in dividend paying stocks and growth assets or growth stocks. And they also leverage it for tax loss harvesting. Like I said, they take loans or portfolio loans against their brokerage account so that they can avoid taxes altogether, and they get to write off the interest that they pay for those portfolio loans. It's just a good look. This is where we talk about the buy, borrow, die phenomenon. Like most of the time, they're not planning to ever sell their stocks. Or if they do, like for instance, if they have 10% returns that year, they'll sell a part of that gain, but they won't sell the base or the foundation of their brokerage account. They wanted to keep growing, which we should all be thinking like that. And then the last bucket is the alternative investment bucket. And so this is your real estate, this is private equity, this is venture capital, business ownership, all of that. And so these investments generally generate some cash flow or appreciation or some type of tax benefits, as in terms of depreciation or 1031 exchange. If you're talking about real estate, private equity and venture capital provide high return potential and diversification with the stock market. Business ownership creates equity value and income. And so you want to invest in these things when you want passive income streams that aren't tied to the stock market. And really, these things are what's going to help you build generational wealth. So how do wealthy think about it? You know, they think about real estate as a way to have regular diversified income stream. They invest in private equity and venture capital for higher returns than what you typically can get from the stock market. Many wealthy people own businesses where they get distributions from and they get cash flow from. They're often thinking about, how do I diversify my investment portfolio? And they do that through alternatives. And so let's talk about the ideal retirement portfolio. So here's how your allocation should evolve with age. So if you're between the ages of 38 to 45, you should still be thinking quite aggressively in terms of your investment. You have 20 plus years before you retire. And so you should be maxing out your 401k to get your employer match. You should be maxing out your Roth IRA. And if you're over 50, you should be putting in the extra $1,000 that you get to do. You should invest extra into your brokerage account. And and extra points if you're leveraging the health savings account, which is a triple tax advantage account, to increase your retirement. And then you should also be thinking about how to incorporate alternatives into your retirement investment strategy. Now, if you are 46 to 55, that's my age, I'm still aggressive. I ain't gonna even front. I ain't gonna hold you. I invest like I'm 38, but that's okay. But if you're not as aggressive as me, you have about 10 to 20 years until you retire. So you should be thinking very, very seriously about tax optimization. And so you should continue maxing out your 401k and Roth IRA as it makes sense from a tax strategy perspective. You should be considering Roth conversions. Like if you're in a lower tax bracket, you should be converting some of your traditional IRA funds or your self-directed IRAs to Roth IRAs, and you should be increasing your allocation into alternatives. And you should start shifting some stock allocation toward dividend paying stocks and income generating assets. So that's how you should be thinking. If you're at a place where you're like, okay, girl, I got all this information and I still don't know where to get started, you should look into joining me and some amazing women in the Sovereign Collective, where we are collectively working together to support each other on our own independent wealth journeys. You can look us up at joinsovereign.co, where we are holding each other accountable and supporting each other as we build the investment portfolios of our dreams. If you are between the ages of 56 and 65, you should be thinking about preservation and income planning. So retirement is only 5 to 10 years away. So it's time to start to reduce your risk and build income streams. So think about, obviously, you want to continue maxing out your 401k accounts to get the match, but you want to shift towards income producing assets like dividend stocks, bonds, real estate cash flow, if that's your jam. You want to do Roth conversions while you're still working, right? Because you'll be in a lower tax bracket than in early retirement. And then you want to build 2 to 3 year cash reserve for early retirement so you don't have to sell stocks in a downturn. You just want to make sure that you are good, right? Like to cover your cash flow in case this recession that some people say is going to happen and some people say is not going to happens, and you do not want to sell your nest egg, right? So think about, for retirement, the goal is you want to invest, you want to have this nest egg that you live off of, but you don't want to reduce the nest egg. Does that make sense? So if you got $3 million net worth, you want to try to live off of 4% returns every year, right? Without reducing that $3 million that's working for you. Okay, and if you're over 65, that means you should be thinking about retirement income and legacy planning. You're retired, you chilling, right? So you should be focusing on how am I generating income? How am I minimizing my taxes? And how am I preserving wealth? So you want to use tax smart withdrawal strategies. You want to live off of your Roth withdrawals, your real estate cash flow, or alternative cash flow and dividends when possible. And then you want to start strategically rolling your RMDs, or required minimum distributions. You want to strategically roll them over to Roth IRAs if possible, or strategically donate them to qualified charitable distributions to avoid taxes. Because unlike today, your W-2, you can use, like if you have a small business, you can write off your small business expenses to mitigate your taxes that you get from your W-2. Unfortunately, it doesn't work like that when you're talking about your RMDs. You have more limited ways to reduce your tax burden on your RMDs. This is very important to start thinking about this, right? And so leveraging perhaps donations or just shifting them to Roth IRAs and paying the taxes that way, and just eating the taxes, but at least you can keep investing the money. These are the levers you have when you're 65 and over. All right, so let's talk about the third pillar, which is income stream diversification. So the wealthy, we already know they don't rely on one income source in retirement. And everybody knows multiple stream of income. It's definitely a real thing when you're talking about retirement. And so here's the ideal retirement income mix, right? So you're going to have your Social Security, right? And I struggle with this one in terms of, sometimes you hear that you should take your money out at 62, and then you hear other people say delay and take it out at 70. So I'm just going to break it down. This is what I know, and then you have to make the decision that works for you. The math says if you expect to live till you're 85, which is a gamble, we all know we could die tomorrow, then you should delay taking out your Social Security until you're 70. But let's just consider these factors, right? So you want to take your Social Security out when you're 62 if, one, you need the money to live on. Like, you need it. You ain't got nothing else, right? You have serious health issues and you don't expect to live past 80. Take the money. Don't let them keep that. Like, you're unemployed and you can't find work. Like, times is hard. You need the money. Or your family has a history of early death, right? It is what it is, right? But you know your own situation. Take the loop. Now, you want to delay taking your Social Security until you're 70 if you're healthy and you expect to live into your 80s and 90s. You have other income sources like your savings, your Roth IRA, your pension, all the things, right? You want to maximize your survivor benefits for your spouse. That is real, right? If you got it and you're like, yeah, I'm just trying to make sure that my spouse is cool if I die, then that's cool. Or you're still working and will lose benefits to the earnings test anyway. So if you know you're working, then just let your money keep working for you. I just talked about your spouse, but again, don't forget to coordinate with your spouse to optimize household benefits. And this is said more for me than you, because sometimes I be forgetting. I just do. And I ain't gonna hold you. Before, and when I was preparing for this, I was always, I'm going to take my money out. 62, I'm going to take it out. I'm going to put it in the market. It's going to do better for me in the market, working for me than otherwise. And certainly I plan to live until I'm 80s. I'm trying to take care of myself, certainly. But real talk, I also plan to be just like Ruth Bader Ginsburg and be working. Like, because I really believe your brain is a muscle. I have issues because my mother has dementia. My dad had Alzheimer's. So I plan to keep using my brain. And so the likelihood is I'm not going to pass the earning test. I'm not going to be able to take the money out when I'm 62 anyway. But trust and believe, I'm going to be working from around the world. Like, I ain't going to be in nobody's office, but I'm going to be working. So that's why this is a very, very personal thing for you to evaluate. So do with that what you will. All right. The second stream of income are your retirement account withdrawals, right? So these are your strategic withdrawals from your 401k, your Roth IRA, and other taxable accounts. Your third stream of income would be if you have any real estate cash flow or you get any dividends from real estate investment trusts or rental income from your different properties. Your fourth stream of income would be dividends and interests. So dividend paying stocks, bond interest that you get. And then the last one would be any alternative investments or business income or private equity distributions, business ownership income, royalties, consulting, side businesses, things like that. But by diversifying these income sources, you reduce risk. So if one stream dries up, you still have others. It's all good. Like if the market goes crazy, you leave that money in because you want to let your money keep working there, and you tighten up and you leverage your other streams of income to make sure that you're covered. And then obviously tax diversification or tax optimization. Having these multiple streams of income allows you to ensure that you have appropriate tax optimization strategies at work for you in retirement. Okay, so I know I just gave you a lot, but here are some action steps just so you can make sure you're good, right? So step one, you want to audit your current retirement accounts. You want to write down how much money is in your 401k, how much money is in your Roth IRA, how much is in your brokerage accounts or your self-directed IRAs that you have, any kind of taxable brokerage accounts that you might have. And then you want to know how much money you have in alternatives. And then you want to evaluate, like, are you over concentrated in a tax-deferred account versus tax optimized account? And if so, you want to rebalance. The second thing is you want to max out your Roth IRA, period. You just do. It's like $7,000. Like, you just need to do that. And if you haven't already, you want to go on and open that account, girl or guy. It's all good. Between me and you, it's fine. Like, don't you worry. I ain't judging you. But you need to go ahead and open it up, and you want to start prioritizing that. It is non-negotiable. You need the tax-free money in your retirement account. Again, health savings account. If you have access to that, go on and do that too. Be like, you can go on and set that up too, because you're going to need it. If you don't have a brokerage account set up, go on and open that up too. Even if you just putting, like, people sleep on sending $25 a month or $50 a month over there. It's something. Start. Just start. You'll get there, but you want to build the muscle of the habit, and then you will start to increase it as your income starts to increase. And then you want to start to think about what role real estate is going to play in your investment strategy. I am not a landlord, don't be calling me, but I do invest passively in larger special purpose vehicles or syndications for real estate. So figure out what your real estate investing love language is, just so you can have additional streams of income, because they do regular distributions. And then you want to start to investigate, do you want to do a Roth conversion? Like if you are currently in a moderate tax bracket, 24% or lower, consider converting some of your traditional 401k or IRA to a Roth IRA. You'll pay taxes now, but if you got a tired look at the picture and it makes sense for you financially, like, yeah, you can go ahead and do that. Work with a CPA to figure out how much to convert each year without bumping yourself into a higher tax bracket. So you want to be thoughtful about that. Work with someone to help you do the math there. And you just want to diversify your asset allocations. You don't want to be 100% in stocks. Good God. No. But you don't want to be 100% in alternatives either. So you just got to figure out, based on who you are, your risk profile, what makes sense for you and your age, right? Lastly, work with professionals. Like, listen, I'm going to tell you, you can't outsource everything. You can't outsource figuring out what your risk profile is, how you want to invest. Do you want people to call you? So do you want to be a landlord or not? You can't outsource figuring out who you are, but you could absolutely outsource the execution of some of this stuff, right? So definitely consider working with a fee-only financial advisor, not a commission-based. Like, you don't want them to be taking a percentage of your wealth forever. If you get them to hire them to do one or two things, you pay them a flat fee. Also, you work with a CPA who understands retirement tax strategies and Roth conversions and required minimum distribution planning, because this is something you need precision on. We're not doing roundabouts here. Like, I need you to know precisely to the penny. My worst fear is you or me having to be a greeter at Walmart at 75, because we did not plan this accordingly. And time is going to pass. So this is something I need you to figure out post haste. Okay? So I hope this was helpful. If this was helpful, please share it with a friend, and also like, follow, and subscribe wherever you get your podcasts. We are on Apple, Spotify, and YouTube. Hopefully, I'll see y'all next week. Right? Okay. Bye.